Hello, and thank you for joining us today. I'm Chris Chapman, co-leader of the Financial Services practice here at Mayer Brown, and I'm pleased to be joined by my colleagues and co-leaders, Lauren Pryor and Jeff Taft. Today, we will share with you some of the highlights of Mayer Brown's new global research study on the financial services industry called The Next Organization, and we will explore some considerations which arise from this new research. With the world in which we all operate featuring rapid and unpredictable change as one of the only consistent things on which one can rely, we surveyed nearly 650 top executives from around the world to learn their perspectives on the business transformation imperative. From them, we learned much about how enterprises around the world are preparing to meet the challenges and opportunities of what we are calling the next economy. As a law firm serving more than half the world's biggest banks and bringing innovative, sophisticated solutions to clients across the global financial sector, we set out to more fully understand what those driving the financial sector believe it takes for their new organizations to thrive and grow in this new economy. We hope you have received your own copy of the research report, and if you have not, ask that you please visit the Next Organization at mayerbrown.com or contact your friends here at the firm so that you can receive a copy of the study. For our financial services report, we included 90 leaders from banking, insurance, and other financial services companies, which we are collectively referring to as financial institutions, and 107 leaders from investment banking, asset management, and private equity firms, which we are collectively calling investment firms. The study covered Europe, Asia Pacific, North America, Latin America, and the Middle East. When asking financial services leaders to think about what their organization needs to do to thrive and create value in the next economy, the majority recognized that they must undergo significant transformation and that this transformation needs to be extensive, rapid, and long-term. Regarding extensive transformation, as you see here, over 2/3 of the financial services leaders believe that their organization needs complete transformation in order to thrive and create value in the next economy. Regarding rapid transformation, over 6 in 10 are concerned that their organizations are not transforming fast enough. Long term, 86% of financial services firms have an overall business transformation strategy in place, but strategies for key areas generally do not look beyond the next 12 months. So this tells us that financial services firms are tending to not plan ahead as thoroughly as they would like. The report goes on to identify these 7 key dimensions of the next organization, which are important to ensure readiness to thrive in the next economy. The research study's participants strongly endorse these dimensions, with at least 2/3 of executives from both financial institutions and investment firms and agreeing that businesses, organizations must consider transformation along these dimensions in order to thrive in the next economy. Interestingly, the highest level of agreement centered on the importance of innovative financing or creative capital as an area of focus. Additionally, participants from investment firms tended to more intensely agree with geopolitical agility and sustainability focus as being among the more critical dimensions of change to be addressed. Please recall I mentioned a moment ago that 2/3 of our respondents expressed concern that their organizations are not transforming rapidly enough. The analysis shown here reinforces this point, as only 1% of participants from financial institutions and 4% of those from investment firms believe they are performing above the average across all 7 dimensions. There is clearly room to grow here. As I said at the outset, I hope you have received your own copy of the detailed report we have just published. If you have not, I urge you to look for the next organisation on mayorbrown.com or to reach out to your friends from the firm to receive your copy. In it, you will find many insights from our survey respondents on the subject of potential barriers to carrying out successful business transformation initiatives, along with potential accelerators of business transformation. At this time, I'd like to introduce my colleagues to ask them for a deeper dive into a few of the concepts I have briefly summarised. Lauren, I will now hand over to you.
Thanks, Chris. First, I'll acknowledge the challenge ahead. The challenge exists for law firms and our clients, and we're working rapidly to get up to speed the same way that our clients are. I'm going to touch on creative capital, some fintech initiatives, and M&A opportunities. Creative capital is a really interesting prong of the 7 pillars. Our clients are consistently looking for ways to get out ahead of regulatory and economic trends. Our finance colleagues are always at the forefront of innovative structures that are designed for capital efficiency, but also to address those regulatory and other tax considerations that are consistently evolving. Sometimes these are complementary to the needs for change, and sometimes they work against the need for change, and we have to work through those inconsistencies. The interplay between the regulatory teams and the finance teams is absolutely critical for our private capital investments and for our private capital clients. An example would be newly rated securitizations in HEI products. For instance, we just got the first securitization for HEI products rated. Another example would be the Basel capital requirements that I know Jeff will touch on in a minute. I think you'll find that seamless service between those 2 groups is imperative for growth and maximizing capital efficiency. And we work to get ahead of those trends for our clients. So, for instance, look at the change from banks to non-banks in the mortgage industry. And I spend a lot of time in the mortgage industry, and we've seen an evolution based on the pressure that banks have been under in recent years to pushing from originations on the bank side to non-origination side, and to the non-depository side. And some of that is regulatory based. There's been a lot of discussion about the potential for future regulation of non-bank depositories in the mortgage space. That will change the landscape, and we're keeping an eye on that in order to be able to keep our clients apprised of those challenges and opportunities as we move forward. On the fintech side, I think it's going to be really interesting. We're all talking about AI, both the positives and the negatives about it that are coming with AI. The legal industry could be changed, healthcare, infrastructure, manufacturing, energy, and all of the financial services companies that have investments or support these industries. And then there's the threats that could come from AI in terms of security and privacy. You'd have a robust cyber and data security process. You have outside counsel that's able to support that with both preparatory work and being able to react when there is a bad actor situation. And growing in the fintech space may require M&A activities to go look for the latest technology to either enhance or protect your business for those opportunities or those threats. And growth through M&A is not just in the United States. We're all living in an increasingly interconnected and global economy. So keeping an eye on the way that there is the interplay between U.S. and abroad, cross-border transactions will become even more prevalent going forward. And we have M&A structures that are designed to keep an eye on the regulatory environments, both internally and abroad, which my colleagues will touch on. And finally, geopolitical agility. And I think this is a really interesting one. We have a global mobility practice here at Mayer Brown that works on how to move human capital around the globe. And that's going to continue to get increasingly more important as we move into the next economy, particularly with tech-based jobs and moving across the border. How do you have talent in the right places at the right time in order to maximize the growth opportunities? Now I'll turn to Jeff to touch on some of the regulatory and other considerations.
Thanks, Lauren. Before touching on the regulatory anticipation aspect, I did want to kind of double back on the technology resilience point. I mean, the financial services industry is really a tech business, and the rapid change and acceleration in tech has led to increased outsourcing. I think the increased outsourcing is something that we're seeing leading to additional risk around third-party vendor risk management. This has become a big issue for the banking regulators and for all regulators, I think, in general. It also impacts and includes, I would say, cybersecurity risk that Lauren had identified, and also business continuity risks that are out there from the use of third-party service providers. I think while most financial services firms have robust third-party vendor risk management programs, we've seen a number of recent actions, enforcement actions, and concerns from the regulators around failures or shortcomings in the oversight of these third-party vendors. Vendors who are providing critical service, where it may be they're vetting customers from an AML perspective. It may be that they're engaged in other types of critical activities for the financial services industry, for that particular financial services company. And this risk is only going to kind of continue as outsourcing becomes more prevalent and technology becomes much more of a driving factor. The rapid acceleration of technology is obviously causing financial institutions and the industry to basically make greater and greater investments. And some of those investments are being outsourced, whether it's cloud providers or the like. And that does create some additional concerns just from an industry perspective and from the regulators' perspective. With that, let me move on to the regulation anticipation. I mean, this is one of the key 7 dimensions covered in the report, as Lauren and Chris have said. I mean, as a regulatory lawyer, obviously, I have a particular focus or in great interest in this aspect of it. This is something that I've seen historically, and it has an impact on our clients, obviously, historically, but potentially even more so now that regulations become far more complex. It's become international, and it's become somewhat inconsistent amongst jurisdictions. Generally, regulatory anticipation to me would include identification of laws, changes in those laws, those existing laws and regulations, and new laws and regulations that may impact the business. There's also a litigation and enforcement aspect of this dimension, I think, and Chris is going to talk about that in a minute. Most large financial services firms have very robust procedures to address and track existing laws and regulations. They have detailed legal inventories that the regulators often make them maintain and update on a regular basis. Similarly, most large financial services firms have procedures to identify new laws that may be proposed both at the federal and at the state level. For smaller financial services companies, conducting a multi-state business in the U.S., for example, it can be very complex keeping up with proposed laws in all 50 states. And then you also have the federal component on top of that, making it very difficult. I mean, for international organizations, there's that added layer. They face additional challenges, but there are also potential additional benefits to be gained by it. International regulation is not necessarily consistent. By understanding that landscape, you may be able to identify what I would call arbitrage opportunities for the business. You may be able to move potential businesses outside the U.S. or to different countries in order to maximize or minimize capital and liquidity and other particular regulatory requirements that may apply to that business. Even for those financial services companies that have robust procedures in place to track new and existing regulations, there's also a need to anticipate how things are going to change and how those changes will impact your business going forward. This is really one area I think where financial services companies can distinguish themselves and gain an advantage over their competitors. Insight about potential regulatory changes and their impact can enable a large financial services firm to proactively shape that law or regulation by working with their regulator or working with those in charge of the legislation. And it can help tailor that to the business before it actually becomes effective. Understanding the broader impact of these laws and regulations can also provide a financial services firm with a leg up or an advantage. This means that the firm can move quickly into new products and new services, kind of get a first mover advantage. If they think that a line of business, for example, is going to be uncompetitive going forward because of regulatory changes, they can exit that line of business. Being able to do that before others react can result in them getting a higher return for that business or getting out of it more quickly. Because once everybody recognizes that there's a potential problem, then it's going to be more difficult to exit the business. It's the same way with entering businesses. If they can recognize that the new regulations will give them an opportunity, they identify that opportunity. As Lauren mentioned, the Basel Capital, or the Basel Endgame proposal, as we're calling it, is an opportunity. I think that we're seeing a lot of financial services companies taking a look at, trying to figure out how that's going to impact their business, mapping those potential changes to their business lines. And I think that's obviously an important aspect of it. How is it going to affect your lending going forward? How is it going to affect the fee businesses that you've put together? Many, financial services companies are undertaking similar types of reviews of their products and services based upon what the federal regulators and the state regulators have basically identified as junk fees or hidden fees. These businesses are now taking a look at changes to their existing fee structures and how those would impact the profitability and risks associated with those products. Financial services companies that are slow to recognize the potential impact of these fee restrictions, for example, may find their business adversely impacted to a greater extent than their competitors. Regulation anticipation goes beyond those laws that are applicable to you and your business. While the report really talks about financial services firms, regulation anticipation is not limited to those in this industry. As regulation increases through new laws and regulations, there's an opportunity for non-financial services firms to basically offer new products and services that historically may have been offered by financial services companies. As Lauren talked about, there are these opportunities that are springing up because of the regulation. She mentioned the Dodd-Frank Act and how that shifted the mortgage origination business from banks to non-banks. We're seeing that a little bit right now in the private credit space, where the traditional lending that was done by banks is now being done by non-banks. I recognize it's difficult for non-financial services companies to follow the laws and regs that apply to their business. It's even more difficult, obviously, if you're trying to figure out the laws and regs that apply to your competitor's business. But this type of exercise, whether it's looking at the Basel Endgame and seeing where there may be opportunities for you, is something that presents an opportunity for you to be a first mover and somebody who can take advantage of the regulation of your competitors. Of course, those institutions, as Lauren mentioned, that are currently less regulated also have to be mindful of the fact that they could become more regulated going forward in the future. Lauren alluded to, obviously, FSOC looking at the mortgage industry and looking at other industries in the U.S. to determine whether additional regulation might be ripe at some point. So simply, relying on the fact that you may not be regulated now may lead to a big blind spot if suddenly regulation pops up and all the businesses that you've been putting together are now subject to a degree of regulation that you hadn't anticipated. Let me turn it over now to Chris, who's going to talk about regulatory anticipation from the aspect of litigation and enforcement.
That's right. So as Jeff mentioned, our regulated financial services clients take great care to track new laws and regulations as they come into force. And the best prepared ones also think carefully about anticipating laws before the regulators have announced them. And I want to talk a little bit about also anticipating some of the other risks associated with that, in particular the risk of enforcement and associated litigation. If you are an international firm, it can be very important to do this on a cross-border basis, because enforcement and litigation trends in one jurisdiction are increasingly affecting other jurisdictions. For example, it is pretty difficult at the moment for global firms to navigate the different regulatory risks and pressures relating to ESG. They have pressure from customers and regulators in Europe to adopt policies and business practices which support environmental sustainability. They also have pressure from customers and regulators in the US who are concerned about the potential impact of that on competition in the market or on profitability. The best prepared firms have managed to anticipate and get ahead of these developments. They are still having a hard enough time navigating the narrow path between these pressures. Other firms have found it more difficult, and this includes European headquartered firms who have underestimated the importance of responding to inquiries from attorney generals in the US, and it includes US headquartered firms who have underestimated the impact of these issues in Europe. It can also be important to understand and learn from local historical trends. As an example, about a decade and a half ago in the UK, financial services regulators dramatically changed their thinking around value for money for retail customers and their ability to take regulatory action against firms for earning excessive profits. These changes arose because of the work the regulators were doing at the time in relation to payment protection insurance. Fast forward to 2024, and the same thinking is now being applied as the regulators implement their new Consumer Duty initiative. Firms who properly understand the developments in 2010 are finding themselves better prepared to deal with these new developments and the very significant redress and enforcement risks that come with them. Finally, I wanted to mention what I think is maybe the most important driver and predictor of enforcement risk and related litigation. The greatest risk in these areas often arise when customers or counterparties suffer large losses. It is not always about whether there is a good cause of action. Firms can incur very significant amounts of time and money dealing with claims and enforcement actions which turn out to have no merits. Firms who understand that one of the key triggers for enforcement and litigation risk is angry customers who feel that they've suffered a loss are better able to predict and manage these risks. Like Lauren and Jeff, I was struck by how many of the firms surveyed in our report felt that they were not sufficiently prepared for the future. We know our financial services clients in particular spend a lot of time anticipating change and risk and future developments. Perhaps the lesson is that the extent and speed of change in the world at the moment feels greater than it has before. We hope our report and some of what we have said today provides food for thought on how you might address some of these changes and become ready for the future. Thank you for joining us.